get right to the floor show. Joining me now, Charles Schwab, Managing Director and Chief Investment Strategist, Liz Ann Sonders, one of the most widely followed and respected on Wall Street. Liz Ann, we've already seen the S&P pull back, nearly 5% since its intraday high of last year. Does that trend continue? And what kind of pressure are rising yields exerting on equities?
I think that's a big part of the weaker equities story, particularly given that the rally since last October was all multiple expansion. There was no contribution from the denominator in the PE equation. And then you saw the upside breakout in yields, and all else equal, that puts more pressure on the more highly valued segments of the market. I think the other issue has been what had become a pretty frothy sentiment environment. And the last thing I'd say is, prior to early June, when we had that concentration problem, you had seen only 15% of the S&P outperform the index. Sorry,
that's
lost
okay.
my voice.
Well, let me talk
over the prior 60
while you clear
days.
your throat, because
believe
me, Liz Ann, I have been there. And I've been the only one on the set. So grab a drink of water. But as we continue, that's what I think people are wondering about, Liz Ann. The Treasury yields continue to rise, and normally that would certainly shake the equities markets. We're not exactly earthquaking here, right? I mean, to me, I look at this and I said, well, the NASDAQ's still rising.
So it's orderly so far, but if you look at the period up until the recent high on July 31st, under the surface, the breadth didn't look great. And unfortunately, in this pullback phase, the breadth is actually a bit worse than what you're seeing in terms of just the pullback. So I think this is a kind of market where you can't just look at what at the index level is happening. You have to look under the surface, and we're seeing metrics like equal weight, the average stock being down relative to the S&P to the tune of more than 10%. So I think it's some of the undersurface stuff that maybe is more connected to the surge in yields, the concern about Fed policy, the stickiness and inflation, all of the uncertainties that we talk about every day.
Well, certainly not under the radar. Above the radar today, you've got S&P downgrading at least 5 banks, the regionals here, and we can look at some of them. They are not doing well today. It's a tough operating condition. That's what S&P mentioned. You've got Associated Bancorp, Valley National, Comerica, KeyCorp, UMB Financial, all of them down anywhere from 2 to 4% now, 4.5% for Associated Bancorp. Borrowing costs continue to surge. How much does that color an investor's thinking?
So I think unique in this environment, particularly since March, when we started what maybe we shouldn't call a crisis. I think Jamie Dimon called it an incident, but whatever we want to call it, right. You've seen the significant underperformance on the part of the financials. And it's often the case that we look to the technology sector to see if leadership resides there. And that usually gives a sense of whether a rally or a bull market has legs. I think unique in this environment is that I think to some degree necessity of financials to start to participate, because if it was some brand new booming bull market that began last October, the absence of participation by the financials would make it the only time you have seen something like that. So clearly a second downgrade matters. And I think we're now dealing with the whole concept of long and variable lags and the ripple effects into the lending environment. And I think that we'll start to see that in some weaker economic growth, which, by the way, may not be a bad thing from the Fed's perspective in terms of an ingredient to continue to bring inflation down.
Well, Thursday, the Jackson Hole meeting of central bankers begins. And of course, we know Fed Chair Jay Powell will be speaking on Friday. If you could, if Powell telegraphs, Liz Ann, another rate hike or maybe 2, it's kind of doubtful too by the end of this year, how should an investor who has a decent time horizon look at stocks if they react negatively? Is that a buying opportunity?
Well, it depends on who the investor. There's no cookie cutter answer to that. It depends on the overall exposure to equities. Are they doing some sort of dollar cost averaging or periodic rebalancing? And pullbacks do offer an opportunity, but that's not a blanket recommendation for everybody. I think we've had this year a few bouts where leadership has gone well down the quality spectrum in terms of the types of factors that were working, where you'd get a pop in the higher volatility, higher beta, but no earnings profile kind of stocks. We've been saying you want to fade those rallies and continue to lean into quality oriented factors. And what's interesting about that is that would have kind of had you in or kept you in some of the mega cap names that were dominant, at least through June of this year, companies that have strong balance sheets and have that strong free cash flow, meaning that they're self-funding companies. They don't need the capital markets. They don't need to go to the banking system. Positive earnings revisions, positive earnings surprise. So we continue to think that that's the way you want to focus on the equity side of things, is stay up in quality. And even though it's not my area, that's been our same mantra on the fixed income side of the equation.
Well, yeah, the Super 7 stocks that had really dominated up until mid-year, I guess, the Microsofts, the Apples, the Nvidias of the world. Breadth, though, overall, market breadth, deteriorating, is it not? And what signals does that send to you, somebody who is an investment strategist looking across the spectrum at how to invest?
Well, it tells you that this is sort of a true pullback. Whether it ultimately becomes significant enough to be defined as a correction, meaning 10%, I'm not sure that the minutia of that matters. But you do want to see improving breadth. In fact, at the October lows of last year, even though the indexes at that time were taking out the June lows, under the surface, you were seeing improving breadth. That's not happening this time. Now, at the beginning of June, when you had all of the performance since October accounted for, particularly since this March period, accounted for by those, the Magnificent Seven, Super Seven, whatever you want to call it, only 15% of the S&P was outperforming the index over the prior 60 days. You actually started to see some beneficial convergence, meaning pullback started up the cap spectrum, but you were starting to see broader participation. That didn't last very long. And now the breadth deterioration is a little bit more broad. And I think we need to start to see some stability there to get a sense that, okay, we at least short term have some stronger footing. In terms of what the investor should do, it goes back to the disciplines around diversification and rebalancing and what I already talked about. Yeah. These are boring things. I know they're not headline grabbing. Maybe it doesn't make good financial TV, but it's really the way to navigate through most market environments.
We're in the business of making quality financial TV, so it is quality advice. That, I think, is the most important thing. And as always, Liz Ann, thank you for giving it. We appreciate it.
Nice to see you.
Liz Ann Sonders of Charles Schwab.